Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. I would argue the technical analysis toolkit is a vital component to a holistic approach to investing. I think of investing with four main pillars. You have the fundamental. What are these companies doing? You have the technical. What about the stocks and the performance of the assets that are based off of the companies and what they're doing? You have the macroeconomic, the big picture, right? What are the overall larger themes like the interest rate environment, the dollar strength or weakness, and geopolitical issues? And then the fourth, behavioral. What happens between your ears, right? The things that prevent you from making good decisions. And I would argue the technical pillar is one of those best ways to minimize the negative impact of a lot of the behavioral biases that we can talk about. Today, what you saw was essentially a choppy flat day for the S&P 500, but the growthy sectors at the top of the list yet again. We have technology back in the driver's seat with Apple and NVIDIA, both having pretty decent updates. Not quite breaking out just yet, but showing a little bit of strength after a recent weakness coming out of the overbought region. With that in mind, let's get to the market recap and focus on how the charts actually evolved through the course of the trading day today. Before we get to the charts, quick poll. We asked you recently, do you currently invest in any active ETFs? Now, active ETFs are often known by a number of different things, smart beta and other sorts of ways of describing it, but basically an ETF that is not a passive ETF, right? A passive ETF like the SPY or the QQQ owns a basket of stocks, and that's kind of it, and the basket could change based on some model. But the active ETF is something where someone, either a model or a human being, is actually changing and weighting the stocks and components based on whatever they think is part of their input. 52% of you, actually half, I was surprised to see 52% of you own at least some active ETF in your portfolios. 20% of you, 19% of you said you've owned them before, but not right now, and only 29% have never owned an active ETF. It's interesting when you think about how the ETF, the world of ETFs has evolved. I mean, it started, I remember when I first was learning about ETFs and what they represented, there were not many out there, but they were just starting to become more and more. And it was all about the prospects of what this new investment vehicle could provide. And now they've really overtaken mutual funds, certainly in terms of new assets, in terms of the opportunities and the liquidity and the transparency that you have, a lot more advantages to traditional funds. Active versus passive ETFs. I find a lot of times investors too much over time have argued about active versus passive. I think the same way we argue about man versus machine or human versus machine. I would argue the best opportunity usually is in combining those two, right? A smart human with a good machine and calculations capabilities are going to be pretty powerful. I think there's a place for both active and passive products in most portfolios. So make sure you do your due diligence and look at the opportunities in active ETFs. As always, be wary of the expenses, which can be extreme in certain ETFs. With that in mind, let's get to the rest of the market recap here. The S&P 500 flat for the day, essentially. We'll look at the daily returns. See a modeled sort of red and green. You have the NASDAQ slightly higher, the Dow slightly lower. And again, generally speaking, you have a more growth-oriented index and a more value-oriented index relative to one another. So this is sort of a growth over value type of day. Mid caps and small caps both in the red. And this is after small caps, really having a nice run. The Russell 2000 ETF, as we've covered, the IWM, nice bounce off of the lows. Still not breaking out of a multi-year base, arguably, but having a nice run here recently. The small cap S&P 600 down today about 1.5%. The VIX in the red as well. So even though stocks were kind of mixed, volatility continued to decline. So we have a fairly low VIX relative to most historical standards, right? Down in a 12 handle type of range. That's low relative to the last 12 months. That's low relative to the last 12 years, to be honest with you. And what that sort of indicates, right, when you have the market going higher on low volatility, that's kind of the classic low volatility bull market phase. No real shocks to the system, kind of a steady incline. The challenge, I would argue, with a lot of things right now, they've had a really good run already in the last 6 weeks. And off of the October low, as we've covered, a lot of things overbought right now, including the S&P, the QQQ. So seeing how that plays out, do we get a pullback with an increase in volatility? That would be the question I'll be looking at through mid-December here. Interest rates, for the most part, all moving down. You have the 10-year yield down below 4.2%, 5-year point below 4.2 as well. The 30-year point right around 4.3%. Now, these are way lower than they were not too long ago, right? We were talking about the 10-year yield hitting 5%. We've gone almost a full percentage point below those levels. So quite a drop in rates. This is what is one of the things that certainly allowed the growth trade to work so remarkably well and risk assets to do quite well here. Bond prices, of course, when rates are going down, that means bond prices are going up. So the TLT, the AG, both having a pretty decent update. Here we have the TLT up 2%. Dollar index up slightly, about 0.4% higher than Monday's close. Looking at the commodity space, for the most part, we're all in the red here. The DBC, which is a broader commodity ETF, is down about 0.9%. Gold and silver down as well. Silver down the most, around 1.5%. Crude oil prices down as well. Energy stocks not having a particularly strong day or a particularly strong quarter at the moment, kind of rolling over as crude oil prices continue to deteriorate. I meant to mention in the intro, by the way, we have a great guest today, Sam Burns of Mill Street Research, joining us from the Boston area. We'll talk about crude oil along with some other sectors and themes as we try to make sense of these markets through year end and into the beginning of 2024. Finally, cryptocurrencies here continue to push to the upside, and specifically Bitcoin. A nice rally continuing to go. Now, Bitcoin arguably pretty overextended by any technical metric I could come up with. If you're looking at percents from a moving average or overbought conditions or any sort of trend, the move relative to a regression line, Bitcoin has had a pretty aggressive run. Tested 44,000 over the course of the last 24 hours. Currently sitting just below that, around 43,700. And again, just continuing to push to the upside. The growth in Bitcoin and certainly the rise in the value of Bitcoin has very much been tied to the expectation, more and more the market pricing in that there will be better access to cryptocurrencies like Bitcoin through ETFs that actually hold the underlying Bitcoin. You're still waiting to get confirmation on what that might look like, but you're certainly seeing the market pricing in that possibility. We also have the Bitcoin halving coming up early next year, maybe in April, as we've covered. Also the seasonal tendencies, which tend to be quite strong, as we've talked about with some of my recent guests. So overall, Bitcoin continued to move higher. Coinbase, by the way, out of the entire large cap US universe, Coinbase currently the top ranked stock in our stock charts scooter ranking. That's a trend following sort of momentum model based on multiple time frames. Looking at the sectors, as I mentioned in the introduction, you have the growthy stuff at the top for the most part, technology and consumer discretionary, the top two sectors. Everything else in the red though. So before you go thinking this is a nice strong up day because Apple and Nvidia and others were up, that's true. And the technology sector, that's true, up 0.6%. The average sector actually pulled back today. At the bottom of the list, you have energy down 1.7%, materials down 1.4%. We mentioned the weakness in some of the precious metals and commodities, and then consumer staples and industrials tied for third from the bottom, down 0.8%. Let's go to a daily chart of the S&P 500, sort of check in on where we're at relative to where we've been. Again, we call this show the final bar for a couple of reasons. One of them is because as I would teach technical analysis, I always tell people start with the final bar and look to the left. So start with the current price and then look to the left. You want to read the chart right to left for the most part. So start with where we're at and look to where we've been. And if you look, right now we're testing this resistance range around 4,600. This is tying into the July 2023 high just above 4,600. We obviously pulled back for the next 3 months or 2.5 months down into the October low. From there, a nice rally into the end of November. And so November pretty much erasing all of the losses that you saw in August, September, and October. Literally a 100% retracement back up to the previous highs. And when you've had that kind of run, which granted, totally impressive, the question always is, do you have enough momentum to continue to go higher? And that's a big ask when the price has already had a run. Now, one of the ways we can calculate that is by looking at a momentum indicator or an oscillator like RSI. And there are others, by the way, in the live Q&A on yesterday's show. We talked about the commodity channel index, and there are others that have that similar sort of way of trying to look at the movements in a stock or ETF relative to the normal trend or the normal kind of pace of the market. So when the RSI or another indicator is overbought, it basically just suggests we've moved too high too quickly. The QQQ, the S&P 500, a lot of leading stocks and a lot of other names, right, in industrials, financials, and elsewhere have shown that overbought condition. And all that means is it suggests that this run that we've had off of the October low probably in the later stages. It doesn't mean we are going down to 3,800 or anything extreme. It just tells you you've probably due for a bit of a pullback. And if you ask anyone that has observed the market over the last 5 or 6 weeks, probably most of us would say that was an aggressive run, probably expect a bit of a pullback. But overall, the strength has been there. And there are a lot of charts with pretty constructive patterns. on any pullback, kind of that basic line in the sand that I would go to is this red shaded area. It's right around 44.50. That's the price gap that we had in early November. The QQQ had a similar price gap there as well, and I'd be looking, if we do get a pullback, if we don't make new highs here to start the month, but actually pull back a little bit, that could set us up with a really good trajectory into that Santa Claus rally, which is usually the last 5 days of December into the first couple days in January, as we discussed with Jeff Hirsch of the Stock Traders Almanac last week. So it's kind of the general base case I'm looking at with the S&P 500. Now, let's talk a little bit about some of the other movements that we hinted at in the intro and in the market recap, and focus on the charts and what they're telling us. This is the chart of the 10-year yield, and I mean, by any stretch of the imagination, by any way I would define it using the technical toolkit, this is a clear downtrend, right? And the TNX, $TNX, which is the 10-year yield, has the gap here on the charts of the TLT and the AG. A lot of those have a gap around that same point. That's from early November. You can see that the 10-year yield kind of pushing lower, now below the 50-day moving average, actually getting very close to the 200-day moving average, which is currently around 4.03%. We'll call it just about 4%. So, 4% kind of a basic level of support that I would keep in mind, just in terms of like a big round number that could provide some sort of downside support. But, overall, the trend remains lower. We're seeing a pretty consistent pattern of lower highs and lower lows. And again, lower rates. If you think about what's changed from September and October into November, this shift in rates has been a big rotation, obviously, and allowing a lot of things to move higher that I think were, arguably being held back by rates going, accelerating to the upside in the third quarter. So fourth quarter now really being a lower rate sort of environment, and again, allowing some strength given the seasonal tendencies as well. It's worked out quite nicely. Another chart to look at would be gold, and if you think of gold, I think gold is twofold in terms of my overall assessment of it. And it's similar to what we've talked about with some of the leading stocks as well. You have a nice run approaching new all-time highs. So this is the gold future. You can see 2,100 an ounce is sort of the all-time high. We set that back in 2020, actually. Essentially retested that in early 2022 and mid-2023. We're kind of back up to those levels. Last couple days, kind of a really volatile stretch here for gold. You can see gold actually traded much higher, up to 2150 an ounce on yesterday's session before coming down. If we look at the GLD, which is an actively traded ETF, you can see we came off a little bit more today, just slightly lower, about 1/3%. If you look at gold, so again, the way that I would think about a short-term mean reversion versus the overall trend, right? Here are a couple things to think about. Number one, look at the price. And remember that Charles Dow's basic assessment of trend, are we making higher highs and higher lows? And coming off of the new low in early October, we've made a pattern of higher highs, and we keep making a pattern of higher lows for now, right? And as long as we, any pullback remains above 179, it's going to be a higher low. So you've got a lot of downside potential to still be technically an uptrend. Now, the other thing you can do is just connect the recent lows with the trend line, maybe a trend line that's not unreadable. There we go. Little brighter trend line. So if you take the low from October, connect that to the low in November, you can see that lines up not too far below where we ended the day today, right? On an intraday basis, we actually got almost down to that trend line. When you have a market that's in a good uptrend like this, and I would say this is the case for a lot of stocks, for cryptocurrencies, for gold, or anything that's had a nice run off of a low in September, October, draw a trend line off the lows. And while this isn't the most sophisticated trading system you'll ever use, as long as we remain above that line, things just aren't getting that bad. And I think that's an important sort of gut check moment, especially when you have a quick reversal after a new high. Just keep an eye on that trend line. We break the trend line, then you can start to revisit it and say, all right, am I comfortable owning this if the GLD goes down to 180 or even further than that? But as long as we hold the trend line, conditions are just not getting that bad. The momentum also is still remaining pretty strong, right? So in an uptrend, you tend to go above the overbought region in an upswing. On a pullback, you usually don't get much below the 40 level, which is the lower end of this green shaded area. You can see we're sort of currently in that bullish phase. We're in sort of the bearish range for sort of the middle of 2023, but now we're back in sort of that bullish range. So on a pullback, do we remain above an RSI level of 40? That would give me more confidence that this is a pullback within an uptrend and nothing any more negative than that for now. But again, that's why we keep an eye on these charts, just to confirm that they're remaining where we think. I will mention Bitcoin again. We talked about it on yesterday's show, again, pushing to the upside onward and ever upward, as we've mentioned during previous bull market phases. Today, Bitcoin getting up to around 44,000, and again, overextended, extremely overbought. All of that is true, but again, overbought means up a lot. That means it's gone up a ton. What you look for are signs of a downside reversal, signs that we've had the run and now we're taking a bit of a pause here. For now, cryptocurrencies, and particularly Bitcoin, continue to show strength. I'm eyeing this 49 to 50,000 level. That would be a Fibonacci level. That's a big round number that we've not seen really since the end of 2021. We're not too far below those levels now. We're about 6,000 points below there. So keep an eye on that one, of course. And as always, keep an eye on the momentum. Look for signs of some sort of distribution. We're not seeing it yet, continuing to move on to the upside. Just to finish off here with a couple individual names to break down before we bring on today's guest. Sam Burns, right? Apple, NVIDIA, some of the mega cap technology stocks having a pretty decent day. So Apple up about 2%. This is after yesterday's sort of hammer candle, I guess I would call it. If we look at the short-term candle chart, see that, right? Where the open and close are at the upper end of the range. Then you have a minimal upper shadow, a long lower shadow. I call that a hammer candle. And you can see a couple of these, right, with the long lower shadows suggesting that buyers are coming in during the day. So today's sort of a nice follow through after that bullish candle pattern yesterday. Still that July high for the chart of Apple and a lot of other sort of growth stocks. Very much the level to watch. I'm skeptical at how much momentum we can gain above those levels as we were overbought approaching resistance, but certainly something to keep an eye on. Meta is another one to focus on. It's actually down about 0.5%. What's interesting about the chart of Meta, right? We broke out and now we're back below that breakout level. So I think Meta for now is featuring what we call a failed breakout. A failed breakout is we have a clear level of resistance. We break above it, but then come right back below that level. And in bullish phases, breakouts tend to work, right? You have a breakout and we tend to continue in that direction. When the market is a little less risk on and a little more cautious, you have breakouts that fail because additional buyers aren't willing to push Meta to a new high just yet, sort of skeptical, waiting to see what's happening. So I think it's an important one to watch as well. Just to finish off here, maybe one or two charts here. AT&T, another one. This group, which is called Fixed Telecom, it's within the communication services sector. It's kind of the old telecom sector, if you remember when that used to be a thing before it was integrated into the new communication services sector a couple years ago. AT&T actually having a decent stretch here, really accelerating off of the July low, up another 3+%. This is a pretty high yielding, fairly defensive play, to be honest with you, but overbought. Nice price appreciation, so nice capital appreciation. Dividend income is pretty decent as well. So showing some real strength and continued strength, right? Higher highs and higher lows. So on a chart like this, it might be difficult to chase it on a day like today. What I would be looking for is a pullback. Look for that higher low, right? Look for a pullback to a low and see where that low. And as long as those lows keep getting higher, as one of my mentors, Ralph Ackenpour, would always tell me, the trend is still your friend. That's it for our market recap, going through some of the key charts of the day. So many we could get to if we had more time, but that's sort of the key things that we're looking for. I'm going to bring on today's guest here in a moment, but before we do so, a couple quick announcements. First off, we welcome your questions. The mailbag can always use some more questions. We had a lot of fun with the live Q&A yesterday, some really thoughtful questions about different stocks, different ETFs, different technical indicators. Keep the questions coming. Email always works, thefinalbar@stockcharts.com. On Twitter, tag us in a comment @FinalBarSCTV. Of course, on our YouTube channel, you can also put a comment below any of the videos you're watching. While you're here, don't forget to like the video and subscribe to our channel. We are so close to 100,000 subscribers to Stock Charts TV, which is such a cool milestone that we are sitting in front of. Also, to let you know, I had a really cool interview with Jeff Hirsch, editor of the Stock Traders Almanac, last Wednesday. Fantastic discussion about the pre-election year, how well the seasonal tendencies have played out as expected, and the projected seasonal tendencies for an election year like 2024. So number one, go back to that interview with Jeff Hirsch last week. Number two, go to the Stock Charts store. That's store.stockcharts.com. We have a Stock Traders Almanac special. You can order it today. Use the code Almanac30 for 30% off the listed price, and we will ship those out very, very soon. Actually, on December 8th is when they're looking to ship out at the end of this week. I have the Stock Traders Almanac every year. I will get another one this year, and hope you can join me following the Almanac and the seasonal tendencies over the next 12 months. I want to bring on today's guest, Sam Burns. Sam is the chief strategist at Mill Street Research based in the Boston area. Sam's been a frequent guest on Stock Charts TV and on my show, The Final Bar. Really thoughtful analyst, helps connect the charts to all the other macroeconomic and fundamental inputs that we may want to consider. Sam, welcome back. How are you?
Hey, David, thanks for having me back on. I'm good.
Yeah, it's good to see you. Hope your holidays were well. It's good to see you back on the show here. As we sort of queue up through December, we have the Fed meeting coming up next week. A lot of questions as we've had such a run off of the October lows. We're starting with your chart of ACWI, the All Country World Index. What's your sense of the markets and the conditions here in early December?
Yeah, no, I think we've had kind of a lot of the good news on the kind of the interest rate front, which has been the real headwind for equities, all pile on. And during November, we had the Fed meeting, and then we had CPI and PPI and a lot of other economic data that really convinced people that the Fed would not be raising rates anymore, and that bond yields would, be more likely to be going down next year than going up, which was, not the case during kind of August, September, October, when there was a lot more talk about higher for longer, or maybe having to raise rates further. So I think that pressure has been removed, and all of a sudden you got this big bounce. But now the major indices are back up close to their July highs. Now most of that you see in the ACWI is really the U.S. The U.S. is a huge percentage, 65 or so percent of the ACWI index. Stocks outside the U.S. are not doing as well. They have not recovered their July highs the same way the U.S. has. So you're starting to see those kind of global divergences develop. But even for the ACWI index itself, those momentum indicators that I look at are just not as strong on an intermediate term basis as they had been earlier in the year. So it still looks a lot more like a move to the upper end of a range rather than a sort of big sort of strong bull market right now.
I really love this chart that you shared with us. And we have a couple that kind of have this similar structure. So just so we all can follow. So this is the 90-day rate of change, 60-day rate of change, and 30-day rate of change. Can you talk just a moment about those three timeframes, what they tell you about just this trend off of the October low here?
Right. So these are kind of some of the inputs that I use for one of the indicators that's part of my overall market timing model, which is now sort of mildly bullish. It's on a 0 to 100% scale, it's at like 55%. So above average, but not strongly so. Earlier in the year, it was well above 60%, which is the most bullish range. So it's not as bullish as it was, but it's still, not bearish. And a lot of what you're picking up in that is that you look at the 30-day change, the lowest one there, and it's quite strong. It's really picked up, and that's the last month or so, 6 weeks that we've seen this big rally. But the 60-day and the 90-day longer term, going back several months, you're kind of just, kind of flattish, marginally positive, maybe marginally negative, not nearly showing the kind of intermediate term momentum that we saw earlier in the year. And no real pickup. You see that 90-day reading has just been flat the last month, even though we've had this big rally. So you're really just catching up, getting back what you lost in September and October, essentially. And that's why that 90-day is still kind of just sitting there, kind of flatlining, which tells you that it has been so far, at least, more of a short-term kind of mean reversion snapback than kind of the early stages of a new bull market move, at least from the way I read it.
Now, you mentioned ACWI, a lot of indexes sort of testing highs. One group that has broken above their July highs, the financial sector. What do you see in the XLF here? What do you see about the financial sector here going forward?
Right. So financials is one area we've been getting more overweight. We're seeing better indicators on earnings estimates, which we watch. And in looking at the price breakout, you can see XLF is broken above its July high. And we're seeing more participation, actually, even from the mid and smaller cap companies within that index, or even outside of that index. A lot of the banks and some of the other companies that had gotten really knocked down the most earlier in the year, after all the Silicon Valley Bank stuff and everything back in March and April. Some of those have started to stabilize. Mid and small cap banks starting to do better. Their earnings estimates look like they're doing better. So it looks like there is a fundamental trend behind this kind of breakout in the XLF that we're seeing. Now it's running back into this kind of that February peak, back before all that the bank problems hit. But I think if the fundamentals continue to improve, it has room to go. And so if you're looking if you've been focused on tech and growth a lot, which most people have been, they've been really where the outperformance has been this year. If you're looking for a kind of a value-oriented sector to kind of counterbalance that, I think the financials are the place to be.
It's a pretty impressive run that we've observed. Names like KeyBank and Huntington Banks and others having a pretty good bounce off of recent lows. We were talking just before we went live about interest rates. It's interesting to me to see how well financials have done in a falling rate period here in November. Can you talk a little bit about how that could make sense? What does that mean for financials to be rallying as rates are coming down as they are?
Right. I think one of the things that's been really hurting a lot of the banks, and particularly kind of those mid and small cap banks, has been the bonds that they own on their balance sheet that they bought, a year or two ago when rates were at 1 or 2%, and now we're at 4 or 5%, and they're still nursing a lot of losses on those. And a lot of investors have been worried because that's part of what brought down Silicon Valley and Regions Bank and those kind of banks. And so, to the extent that higher bond prices, lower bond yields that we've seen in the last 4 or 5 weeks basically help the balance sheets of a lot of those banks. They reduce their losses or give them some gains, let them kind of get out from under that hole. Then that's a net benefit to their fundamentals. Their balance sheets are in better shape now. And so if you've still got relatively good lending spreads, meaning banks can lend out at higher rates than their deposit rates are, because deposit rates haven't gone up that much, they're still in a kind of a profitable position for new loans and can get out from under some of those pressure from the existing losses on their balance sheet from the last year or two. So I think those two things combined are helping them improve. So it's been insurance companies, which can benefit from rates, banks, and some of the other financial services companies are really where we're seeing strength across the financials.
That's great. Well said, Sam. Your final chart, we're talking about crude oil, right? And talk about something that's actually been diverging from the rest of the market, really rotating lower while risk assets have been moving higher. What do you see with crude oil here continuing to show weakness, I think, into December, right?
Yeah, and this is an example of the idea where the price is not following what the narrative in the news is saying. If you look at what's happening in the Middle East or Russia or what OPEC's trying to do by cutting production repeatedly, oil should be going up if you just kind of read the headlines. But it's not. It's clearly, as you can see in the trend, it went up, kind of over the summer and is now broken back down again. It's no higher than it was at the beginning of this year, and certainly far below where it was in the middle of last year after the Russian invasion of Ukraine, which kind of produced a much bigger spike. And so if all these events that should be pushing oil up are not, that tells me that the trend is probably lower. And we've seen oil prices act that way. We've seen refined products like gasoline, and we've also seen natural gas act that way. So across the energy space, as well as other commodities like the metals, industrial metals and things, most of them are in kind of flat to down trends. So to me, that tells you that the demand for commodities, including oil, is relatively weak. China's relatively weak. Those are all things that kind of would make me think oil is more likely to go down than up, and therefore energy stocks, commodity stocks, material stocks are all probably going to be facing more headwinds relative to other parts of the market.
This is like a beautiful, justification for technical analysis, in my opinion, Sam. I love that. You think about what the crude oil price should do, given all of these headlines. Let's focus on what actually is happening, right? Crude oil is going down, and I think that's the trend to pay attention to. As you're looking between now and year end, we obviously have the Fed meeting, the last Fed meeting of the year, next week. And while it's pretty much a 0% chance of any change in rates, it's all going to be about expectations going into next year. When you look forward into the first quarter of next year, do you have a sense of optimism about equities, or is it more of a cautious, there's still a lot to prove sort of sense? What do you see in your work?
So what I'm basically saying is, that the Fed is now much less of a driver. Most people have decided that the Fed is not going to raise rates anymore, either in December or next year. And there'll probably be some rate cuts at some point next year. As inflation continues to come down, rates at 5 or 5.5% are no longer necessary and are going to be too restrictive. But I think the key thing will be not too much growth or too much inflation, but too little is the risk. And so I think if growth can hold up, and inflation does, continues to come down, that will be the good scenario. And I think, at the beginning of this year, expectations were really low, and it was much easier to beat expectations, to come in above consensus, essentially, for the economy or for earnings. Now expectations are higher. They're not super high, but they're definitely higher now, and markets have moved. So I think it's going to be harder to beat expectations and to really show kind of extraordinary, positive upside surprises. But that doesn't mean you're necessarily going to go down a lot. It just may mean you're in kind of a choppier, kind of grind higher or range bound environment going into next year than you would have been at the beginning of this year.
When you and just one final question, Sam, this has been fantastic. I really appreciate you going a lot of different places with our discussion. When you go into next year, obviously the markets have had a pretty good run. I mean, it looks like here in November, December, we'll see how things play out, but seasonally tends to be pretty strong. The challenge, I think a lot of people are concerned about a potential recession, what that might look like. What would you need to see in your work that would tell you, okay, this is a time to really get defensive, right? Is there a move in the major indexes? Is it a lack of support from the mega cap names that have been so strong? Is it something with rates or the dollar? What would be sort of your go-to tell of, okay, this is starting to be a pretty ugly start to the year? What would that look like for you?
Yeah, no, I think if you really start to see breakdowns in the leadership, which has mostly been technology, or technology and technology related areas that have had the strongest earnings and had the strongest, returns, that if those areas started to really kind of crack and you didn't have anything else to compensate for that, to come along, then I think you'd have an argument that the things looked weaker and you start to see risk appetite really start to break down. I think risk appetite has improved. It's not as probably going to be as strong this year as it has been, earlier in 2023 here.
Mm.
But I would get concerned if that were the case. And like I say, I think the risk is that growth slows too much. Europe's not doing well, China's not doing well. The U.S. is really kind of the island of strength right now in the world. And if the U.S. starts to kind of slow down, or you had some of the fiscal policy that's been helping the U.S. really weaken for some reason, then that would tell me that some of those tailwinds that are helping offset what the Fed has done would be lost, and you'd have much more of a recession or a slow growth, weaker earnings kind of story, and that would, I think, cause earnings to weaken and cause the market to pull back.
Well said, and thanks for pointing out that divergence we're starting to see between the U.S. and non-U.S. I think becoming a little more magnified here recently. Sam, this was awesome. I wish we could keep talking longer. It was a lot of fun to pick your brain a little bit. Thanks for bringing some charts and insights with you. Have a fantastic holiday. We'll look forward to having you back in the new year.
Sounds great. Thanks for having me on.
That's Sam Burns. Sam's the chief strategist at Mill Street Research, coming to us from the Boston area. I mean, what a thoughtful, knowledgeable guy. What a pleasure to talk to someone like Sam and ask questions about things before we went live. I was asking legitimate questions about what would this mean, what would this look like, and someone like Sam, just a nice, patient way of describing it. Some really interesting thoughts there about what the beginning of next year could look like, and I love that sort of general thesis about sort of a slower growth environment. I feel like a lot of investors are looking for lights out, sort of the AI fueled rally or the end of the world, decline. And there are a lot of middle options that are sort of like a slow grind higher. It could end up being a lot more like that. Great take there from Sam Burns at Mill Street Research. Folks, we've got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. We're talking about bonds. And again, I thought Sam Burns did a really good job describing the interest rate environment, what lower rates may mean, and particularly how financials are able to benefit from the current movement in rates. When I've seen rates decline so quickly, when I've seen bond prices rally so quickly, I immediately have a mean reversion hat, which I dust off a little bit, pop on my head and think, okay, is there a short-term mean reversion that could still fit within the trend that we've seen? And when I'm looking at the Ag ETF, pretty impressive rally off of the lows, and I think future textbooks on technical analysis should probably include this chart of the Ag with a beautiful bullish momentum divergence suggesting the low in October really played out that way. Now we're sort of rallied back. The RSI went from oversold in early October to now almost overbought in early December, and we're approaching a previous level of resistance. I would not be surprised if a chart like this has a brief pullback at least before we sort of reset. And I think there's plenty of room for a pullback and still be within a pretty good uptrend for bond prices. And again, rates can kind of remain in this sort of low 4% range. It's going to feel pretty bullish relative to what we saw on the acceleration higher in rates. Chart number 2, what's interesting now is as bonds have continued to rally, as some of the mega cap growth names have started to rotate lower and our major benchmarks are testing previous highs but not really continuing higher, the stock to bond ratio actually breaking down a little bit. Now let's keep this within proper context. We're looking at the last 3 years and you can see this ratio has clearly been favoring stocks over bonds, and that's in bullish years like 2021 and the first 3 quarters of 2023, and bearish years like 2022. Stocks still overall outperformed bonds during that period, but there were some of those counter trend moves where stocks were actually underperforming. We're sort of in the middle of one of those here as well, and I have not seen enough to tell me that bonds are the new asset to own and don't own stocks whatever you do. This is an important one to watch because I think one of the great trends that we've observed has been the strength in stocks over other asset classes. Keep an eye on this ratio to see if that dominance may be brought into further question. Finally, chart number 3 of our 3 in 3, the Grayscale Bitcoin Trust, GBTC. I think, the upside for Bitcoin involves us having a lot more options other than GBTC as a way to make a bet on cryptocurrencies to the upside and or the downside. When I'm looking at the GBTC, again, an impressive run higher. GBTC was down around 18 in late September. We're now, basically a double up to around 36 here in early December, up another 4% today on the strength in Bitcoin. What's interesting now is if you draw a trend channel through 2023, so I'm taking a high in January, lining that up pretty well with the highs in March and April, lining that up with the high in July. I made a parallel line down here at the lows from the low in December and June and September. What's interesting is right now we're actually above the upper end of the channel. And the reason why I illustrate that is I think this could be a scenario that we're in for a lot of different charts. The trend overall could still be positive going into next year. There's a lot of room for the GBTC and Bitcoin and other things to move down and still be within a larger uptrend channel. So think of channels as a way of defining the larger trend and understanding the short-term tactical moves and how they fit into the overall trend that we're seeing in the broader market movements. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Sam Burns of Mill Street Research joining us from Boston. Don't forget to like our video and subscribe to our channel while you're here. We're so close to 100,000 subscribers. Why not help us move to that big milestone? For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.